Is this a true market reversal or simply a dead cat bounce? Are we selling this rip or are we starting to buy some of the more oversold names? In this video, we're going to go over some different breadth statistics and look at the major market indexes and come up with a logical answer at the end of this video.
Could have been on Wall Street. Should have been on a ball team. Could give a fuck about y'all team, cause I don't really feel none of y'all. Morphine, Wall Street.
So we're going to start off here looking at the Qs, right? We have the three major market indexes, SPY, QQQ, and IWM. We're going to start with the Qs because, well, it's up right now. We have a logical level here at the 296 area that we've been looking at inside TTI for the last 2 trading weeks-ish. And we said, listen, a break above this level, and potentially we could be looking at a short to medium term trend reversal. Yesterday we got the breakout. We did not get the amount of volume that we normally like to see on a breakout, but today we are up again. So this is a valid breakout. We are now up and over, flipping this level at the 296 area that we have tested 2 prior times during the oscillation of this fractal. You want to go ahead and draw this series of higher lows, somewhat resembles an ascending triangle. We're not typically trading this sort of pattern breakout off of the floor, but it's something to consider. We did hit a period of higher lows with a accompanying overhead resistance where price was stopping out at 296, and that's technically, if you're a classical technical trader, that's an ascending triangle, right? So we're going to go ahead and delete that because I don't really care about it, but some of you might have immediately recognized that and said, wait a minute, I know what that pattern is, right? What I'm looking at here is that RSI is now firmly above the 50, and this is a big deal within TTI. We know that when the RSI is above 50, the odds of these trends continuing grow exponentially, right? We're in a bullish momentum regime. The Qs are breaking out. And then let's add one more flavor here, the 50-day moving average. This was touted on social media for quite a while up to yesterday's breakout, right? We said every single time the Qs tested the 50, we broke back down below. It happened once in March, mid-March, we broke up and over. At the end of the March, obviously, it was a failed breakout. We popped up, rejected off the 200-day moving average, and then came back down. RSI was above 50. It's important to understand that just because I have a slightly more bullish stance on right now's price action, I cannot overlook that we tested this exact same area with the same sort of price action, and it didn't hold last time. But something to consider that's a little different is we did not have a period of higher lows, a period where we stamped a positive floor, in this case in the middle of June, and then we're unable to pierce back below those lows. That is important to me. I don't typically trade with moving averages, but because they're on the chart right now, and I wanted to bring them up because everybody is seemingly talking about them, we do have somewhat of a golden cross setup where you have the short-term moving average, which is the 20-day, crossing up and over the long-term quote-unquote moving average, which is the 50, and both of these are, at the very minimum, not sloping downwards. That is a big caveat to a golden cross. You want both of these moving averages moving in the direction of the trend that you're looking to play. So in a golden cross, you would want these both sloping upwards. This exponentially increases your probability of it actually playing out. And as you can see in the previous example, we did not have that golden cross crossover. I do not buy golden crosses, but it is a piece of information showing you that the short and medium term are at the very minimum not declining at the same rate as they were back in March. This is constructive price action on the Qs. Now let's go ahead and move over to SPY, simply because obviously it's the biggest market index and we have to take into consideration what value is doing in this picture as well. RSI peeking its head above 50. Once again, that's the first step of a bullish momentum regime. SPY recently broke above the 50 moving average. Now it is still sloping to the downside. We'd like to see it start to curve and form a floor before pointing back upwards, but the 20-day moving average is. We have a series of higher lows. We have a series of horizontal resistance areas that we've tested, and we had the breakout yesterday that accompanied with the Qs. Now, right now, value is underperforming against growth over the last 4 weeks, so it's not surprising to see the Qs take relative strength against SPY, showing you that SPY is just simply not performing as well as the Qs, and I'll be honest with you. In a risk-on environment where we expect the market to potentially bounce here and start creating higher highs, we want growth to be leading. So it doesn't necessarily, cause me concern that value might be underperforming against growth right now because the market tends to move better, cleaner, more efficiently, and up when growth is in charge. Let's go ahead and finish it off with IWM. IWM was realistically the first sort of area of the market that we were looking at where we go, hey man, something is going on here with IWM. There is something definitely going on here. We stamped out a low in the middle of June, just like the other major market indexes, but we had a change of trend here with a declining series of higher highs here. Now this somewhat looks like a descending triangle. Once again, I don't typically use this stuff when I trade anymore, but it's something that you have to take into consideration that we were unable to break below the 167-ish area. Inside TTI, we had the descending trend line, more so just as a gauge of risk. Listen, we have a general downtrend coming on within this short-term fractal. If we break above it, that is a change of attitude. Not only that, but we are now bouncing above the 50 RSI. Same thing as the other two major indexes. I'm going to go ahead and delete this so you can get a general idea though. The 20 is curling and the 50 is flat. Once again, the 50 is flat. This is a very good sign. If a crossover does end up happening here, it's showing us that the short and medium term are potentially both pointing up for the first time. We see the bounce back in March. We see that the 50-day moving average was flat. We have to take that into consideration. It's sort of the same setup as right now. The difference is, and what we'll look at in 1 second, is that growth is leading here and not value. And I think that that is a very big part of what's going on right now. So as of right now, IWM looks relatively bullish, at least in the short term, and what we want to see is this manifest itself into a medium-term trend change, and potentially, who knows, is this a potential floor? It's still way too early to understand and call out for sure, but this could be an opportunity to start buying those oversold areas of the market, expecting, at least in the medium term, a reversal here in the market. Now, I stated that I wanted to show you guys the difference between small cap growth and potentially, small cap value and what's going on. We are very pertinent within TTI to check out the difference between growth and value. I said this before, but the market tends to move more efficiently and more bullishly when growth is in charge, and there is no better indication of a growth move, of a bullish move, than this IWO, right? IWO is your small cap growth. So if you think of risky parts of the market and you think growth is inherently more risky than value, small cap is inherently more risky than large cap, what would you expect if I asked what's more risky, right? Small cap growth or small cap value? Your answer should be small cap growth. So IWO is showing the same sort of breakout up and over a horizontal resistance level at 216.15, same series of higher lows. 20-day moving average and 50-day moving averages are about to start crossing up and sloping up. You're above 50 RSI. This looks very, very good. If you're looking for a reason to add risk into the market, we love to see the small cap growth ETF start to outperform. One thing to consider here is that off of the lows, IWO is up roughly 13 to 14%, give or take 1%, right? So we're up off of those June lows 13-14%, and that is huge when you compare it to IWN, your small cap value. So when we compare these things within TTI, we look at growth versus value. We understand the relationship in investor sentiment when it comes to growth versus value, and we understand that growth typically allows the market to move more efficiently. Well, this support level here with value is great to hold. If you would have bought the support area and expected the market to bounce, you would have made a couple bucks. But here's the big deal here. We know that growth typically outperforms value in a bullish and risk-on environment. If we look at how the value ETF has moved, we're up 7% off of the lows. That's not bad. But when we take into consideration that growth is up 13 or 14%, this is the underperforming area of small caps. So when we talk about risk in the market and understanding that growth matters more than value most of the time in risk-on environments, we can go, IWO is outpacing IWN right now, and that is a huge green flag for risk on appetite. Two more things we want to bring up here really quick, and it's crypto related, right? Bitcoin. Now within TTI, we view crypto as an extension of risk. That's what it is. It's mainstream now. You have hedge funds and other major funds and big whales and retail traders. Everybody's trying to get in here, regardless of whether or not they're dedicated crypto traders. They want to be able to trade and invest in this stuff because it opens up another avenue of risk. So within TTI, we look at crypto and BTC and Ethereum as risk on areas of the market, kind of like IWO, except maybe they're even more risky. So we understand that when crypto in general, but Bitcoin and Ethereum for certain, and we also look at market cap, right? When these things are popping off, we understand that risk is coming back into the market. There's a reason why people are buying BTC, and it's not because some country is about to make it legal. It's none of that garbage, right? The Qs and crypto have been correlated for a long time. If you don't believe me, run the simple correlation coefficient indicator across the two, compare them, you can see it, right? It's nearly a 1-to-1 in some instances. BTC double, triple bottom, however you want to look at this 1890 area, $19,000 area. And over the last few trading sessions, we are breaking up into higher highs. This is a 20-day high here with BTC and the accompanying 20-day high in Ethereum as well. These are risk on areas of the market. It makes total sense that if IWO is outpacing IWN, small cap growth is outcompeting against small cap value, and the major market indexes are showing potential floor here, at least in the short to medium term, that risk on areas of the market such as crypto would start to pop. One step further, we have risk on areas within small caps themselves. You have the biotech area, right? Biotech notoriously got beat to shit after peaking in February of 2021, coming all the way down nearly 64%. That's a huge sell-off in a major ETF. And as of right now, after double bottoming off of the May and June lows, we are up roughly 33% in the ETF. This is a very risk-on area of the market, and this is not the only one. You can also see ARK double bottoming off of the May and June lows. This is a big deal in the market. Some of the worst stocks over the last year and a half, right? ARK has been notoriously just underperforming everything. These were down 77% at one point. What are we up right now, right? We've double bottomed. We were unable to break those lower lows. The market is starting to bounce. They're starting to reward risk again. We see it with XBI. We see it with Ethereum. We see it with BTC. It's up 33%. ARK names are up 33% off of the double bottom. One more area of the market that doesn't normally get any love, and that's okay. IPO. It's an ETF that lists a bunch of recent IPOs and their performance. Listen, if you're in a risk-off environment and you want to sell the riskier parts of the market and get safe, I can't imagine you're going to want to go and actually buy some brand new IPOs that haven't really proved themselves, right? This is down 65% at one point. We double bottomed, that same double bottom from May and June. It held, and off of those lows, we are now up, 21, 22%. This is a big deal in a market where we're looking for reasons to add liquidity into risky areas. These areas of the market are very risk on. Traditionally, people don't want to be buying biotech when they're worried that the market is going to crash. They don't want to park a bunch of cash in Ethereum or BTC if they expect it to continue to go down 20, 30, 40, 50%. These areas are being bought and accumulated now. And let's look actually at some breadth stuff. Welcome to the patternsite.com. If you don't know who Bukowski is and you're a technical trader, you're not a technical trader. You need to learn who Bukowski is. Absolutely one of the most brilliant minds in technical analysis. He runs a blog. It's all free. All of your favorite chart patterns are on it. So he wrote up this blog. He writes it once a week in regards to breadth. And he wrote a very interesting piece today, and I want to point it out really quick. He has percent down indicators versus the S&P 500. You can see the chart really quick. I'll let you look at it. You have the blue line, the red line, and the actual performance of the S&P 500. Shown as a red line on the above chart. On Tuesday, 65% of stocks in his database were in bear market territory, which is down at least 20% from their one-year highs. A week ago, it was 70%. The fewest was 19% on July 29th of 2021, and the most was 79% on June 17th of 2022. If a week ago it was 70, and because I follow this, I know the week prior to that was like 78. Yesterday was 65 percent of stocks in bear market territory. That means breadth is gradually improving. You can see it on the red line. Now, we're not out of the woodwork yet. I need to point that out. It's still too early to say go out and buy everything, but it has to start somewhere. The floor has to be found somewhere, and it's not going to be pretty. We're going to see it in breadth before we see it anywhere else. The problem is this going to be another fake out or not? There's a few things that make me think that it's not as likely, to get sold off like it was last time, but, there is still that probability it is. But as of right now, and over the last few trading weeks, breadth has been improving. There are less and less stocks in his version of bear market territory, which is 20%, down 20% from the one-year highs. And as of yesterday, July 19th, only 65% of the stocks were in that territory, down from 70% a week ago. Now, shown as the blue line here, 454 stocks in his database are down an average of 28% from their yearly high. A week ago, the average was 30. The peak was 12% on August 11th of 2021, and the bottom was 33% on June 16th, 2022. Once again, breadth is improving. Once again, is it time to go out and buy everything in the market? Absolutely not. But it has to start somewhere. Breadth has to start improving, and we're going to see it there before anywhere else. It's going to be hard to notice, but I'm calling it out now through Bukowski and some of the stuff that we do within TTI. Breadth has been improving over the last few weeks. It has to start somewhere. It could be starting now, right? He ends his little thesis here with the chart on the red line shows a higher low. Anybody that knows technical analysis understands that. You can call it an ugly double bottom where the second bottom is above the first. Sure, why not, Bukowski? Both charts are bullish this week, which suggests the upward move has staying power. Yes, we could see a retrace, especially if a popular company falls short of earning expectations. However, this might be a good time to bottom fish for securities you've wanted to own. So I hope you guys understand what we're going through here, right? Bukowski says, listen, breadth is improving, right? Breadth is improving incrementally week over week. We're looking at the major market indexes and we're going, listen, we're starting to create higher highs. We have a series of higher lows. These are legit breakouts. Do they hold is the hard part. And that's why we are rewarded by putting risk in the market. We risk our money every day. We take calculated plays based off probabilities. And as of right now, at least in the short to medium term, it seems to me like we are starting to round a little bit of a corner here. We could potentially see a short to medium term trend change to the upside. There's only one reason why the market wants to buy things like biotech in a bear market, and that's because they expect them to go up. And in what type of environment is a major ETF like XBI going to go up? It's if the market wants to start rewarding risk again. So I hope this helps. Feel free, if you disagree with me, if you agree with me, leave it in a comment below, and I'll catch you in the next video.